the best of Money Matters.
Market View on Money FM 89.3.
That's right, you're tuning into Money FM 89.3. Time now for Market View with me, Chua Tian Tian, where we take a look at how the Singapore stock market closed for the day, the biggest movers, sectors, and of course the companies to watch. But as always, a quick recap of how we started. Well, Singapore shares began the day trading in the green after markets abroad ended the previous day with gains. Now, in early trade, the Straits Times Index was up 0.3% at 3,886 points. After some 50 million securities changed hands in the broader market. But as we told you earlier, the STI gave up those gains to close in the red. So let's take you through the closing numbers. Well, the STI closed down 0.37% at 3,860 points. In terms of value turnover, we are looking at 1.34 billion Sing dollars. Gainers trailed losers 238 versus 267. Top advances for today, we've got your Venture Core, GMXUSD and iFast. And top decliners, let's take a look at them. We've got here DBS, UOB and Megacam. Now in terms of counters to watch, we have Paragon Reit, given how Times Properties is looking to take Paragon Reit private by way of a trust scheme arrangement, and that is for 98 Singapore cents per unit. Now elsewhere, from US President Donald Trump raising tariffs on steel and aluminium imports to how a consortium led by Elon Musk offered $97.4 billion to purchase the non-profit that controls OpenAI. We've got more international and corporate headlines in focus for today. And joining me on the line is Jeremy Tan, CEO at Tiger Fund Management. Jeremy, welcome.
Hi, Tian Tian.
Great to have you join us. And Jeremy, let's start with the U.S. this time around. U.S. President Donald Trump, he said this morning that he would announce plans to impose reciprocal tariffs on other countries over the next 2 days, doubling down on those comments he made on Sunday. Now, at the same time, he said this as he signed two proclamations ending all exclusions on steel and aluminium tariffs first imposed during his first term, raising tariffs for both metals to 25%. Now, aside from that, he also said he was looking at tariffs on cars, semiconductor chips, and pharmaceuticals. A lot of things happening at the same time, Jeremy, but how did investors react to that flurry of news?
Sure, if you look at overall markets in the U.S., they've obviously brushed aside concerns vis-a-vis the first round of trade tariffs last week, where actually Trump announced tariffs on Canada, China, and actually Mexico. But however, they were subsequently actually postponed, especially for Mexico and Canada, with the exception of Chinese good tariffs. That 10% actually took effect. So I think that the market is reassessing whether this round of trade tariffs is perhaps a bit more of a political bargaining chip during the Trump 2.0 stance. I think that going ahead, I think the markets will be a lot more uncertain about whether all these trade tariffs play through or to what extent it actually plays through. With that said, S&P 500 has done well last night. U.S. steel makers, gold, oil, they all strengthened in light of the inflationary environment that we are expecting. For technology stocks, they have also been performing well, with the Nasdaq closing up higher on the back of this U.S. exceptionalism trend that Trump 2.0 is painting. And for Asian stocks, I think you can see that was actually largely mixed. They have actually corrected. The fresh tariffs will pose an impact on trade partners, and that could actually dampen global growth and raise inflationary pressures.
I see. Well, going back to the Singapore stock market, as usual, Jeremy, how did the STI fare today? And any surprises when it comes down to the companies or counters to watch, say Paragon Reit, given how Times Properties is looking to take it private by way of a trust scheme arrangement, and we're looking at 98 Singapore cents per unit over here?
Well, I think overall STI was actually down against the other Asian peers. It's actually down by about 0.3% today. Banking stocks and other cyclical names, they have all shown a bit of a distraction against the Asian peers compared to the US that actually outperformed. I think what actually surprised us today was actually the proposed acquisition of Paragon Reit. We have seen, there is a lot of action on the property space as usual in the STI, surprising us with another round of a delisting of a name that is well known to us. We have seen a lot of challenges, especially in the luxury sector, which Paragon Reit operates in. There is actually persistent slowdown in the luxury sector, and the company is actually facing also other challenges as well. There's actually very limited coverage, low trading activities, and perhaps institutional investors are not looking at this space as much, especially the REIT space this year. With actually the long-term yields actually creeping up slightly, that actually puts REIT sector at a disadvantage vis-a-vis the current rate environment.
Well, Jeremy, from Paragon Reit, let's have a look at Guaco Land, because the property developer posted net profit of 74.6 million Sing dollars for the first half ended December, up 13% from that 66.2 million Sing dollars we saw in the previous corresponding period. Now, what do you think is the outlook ahead for property developers, given two things? One is higher for longer rate environment. The second one is the trade tariffs on steel and aluminium imports into the U.S. Would that in any way affect local developers? For instance, are developers here procuring any downstream materials from the U.S. that uses imported materials?
Well, for the overall Singapore development sector, I think we are still cautiously optimistic despite the higher for longer rate environment that you were saying. I think this year we could potentially see a rise in transactions. I think overall mortgage rates are actually less impacted by the short-term rates that we are seeing, because long-term rates in Singapore for mortgage rates, they have actually fallen year on year. That actually puts the prices for servicing a mortgage actually lower in 2025 vis-a-vis 2024. And we do expect to see this year new launches that actually double that of 2024. So overall, we can see that there is actually very resilient demand in Singapore coming from upgraders, from new buyers. And this year, we would probably see prices of private properties actually stabilizing from the last 2 years that we have seen 3.9% in 2024 and 6.8% rise of property prices in 2023. This year, we could see a much muted impact of about 1 to 2% rise in private property prices. And overall, you can see that I think Singapore developers actually will probably be impacted by prices as well, perhaps less, to some extent lesser than expected, because they actually import much of the building materials coming out from China and from Malaysia, those closer trading partners vis-a-vis the US. I think the US do continue to pose a risk in terms of overall global inflationary pressures that's actually slightly creeping up from these Trump 2.0 trade tariffs. I think that would be the overall backdrop that we are seeing. But I think overall we shouldn't expect to see a big rise in inflation for 2025.
If you're just tuning in, we're now in conversation with Jeremy Tan, CEO at Tiger Fund Management. Well, Jeremy, across the region, BYD shares briefly rose to their highest intraday price on record. Now, if we look at BYD's Hong Kong listed stock, that jumped as much as 4.5% to an all-time high earlier today, after the firm unveiled plans to enable advanced driver assistance features in almost all future models, and that is at no additional cost. How do you read into the optimism, and what is your assessment of BYD's lead in the EV industry?
Well, I think we are continuously to be very positive about China EV makers. I think what we have seen over the last few years is that the Chinese automakers, they have proven to actually produce a very good product at an affordable value for consumers. And as a result, on this backdrop, I think BYD in 2024, we have seen a record high in terms of their passenger vehicle deliveries to the tune of 4.27 million vehicles delivered. And that's actually triumphed even Tesla's 2024 delivery of about 1.79 million vehicles. So in fact, in closer to home, BYD has actually dethroned Toyota to be the number one seller of vehicles in Singapore. I think even though the competition of the EV landscape is actually very intense, I do think that the Chinese automakers are here to stay, and they seem to be able to compete very well in this current environment to produce very strong products. I think recently, BYD has seen another round of, I would say, optimism for their stocks. The announcement of its advanced driver assistance features at no additional cost, called D-Pilot. This will also be implemented in their lowest cost vehicle products that's probably transacting about $10,000. And in the future, I think BYD will also integrate DeepSeek software into its car in its highest end vehicles. So I think overall, in all, I think BYD is transitioning from a low cost to actually a competition landscape that actually increases its function in 2025.
I see. Now, further away, Jeremy, let's look at McDonald's, because McDonald's posted disappointing quarterly revenue in the previous session. If we look at U.S. same-store sales in particular, it saw a steeper than expected decline, down 1.4% in the latest quarter as compared to that 0.6% fall expected by Wall Street. So McDonald's said that even though traffic was up, customers tightened their purse strings. So how would you read into that? What does it say about the spending power of U.S. consumers? And do you expect that to be reflected in the earnings of Coca-Cola and Kraft Heinz later on?
If you look at the overall of McDonald's earnings, I think this quarter they have been hit, obviously, by not only the weaker consumer sentiment, but also an E. coli outbreak that actually affected the quarter. This could be a one-off incident. But what we have seen is that the traditional defensive industries are actually struggling right now, especially in the lower income segment. And this is perhaps due to the consumer environment, the persistent inflation concerns that has actually impacted the lower income segment the most. And as a result, the lowest income segment are actually looking for value, and they are actually cutting back on spending, especially on spending in the lower end restaurants, and also some of the names that you have actually mentioned, such as Kraft Heinz, Coca-Cola. These were traditionally more defensive industries, but they are actually impacted because they are actually the first, I would say, products that consumers actually cut, especially for lower income segment in this space. So we do expect in the upcoming round of Coca-Cola and actually Kraft Heinz earning, they could potentially report lower than expected year-on-year revenue and expected earnings as well.
And finally, before we let you go, Jeremy, we'd like to end off with a fun question. So this one, a consortium led by Elon Musk said yesterday that it offered $97.4 billion to buy the non-profit that controls OpenAI. Now, that is another bit in Elon Musk's fight to block OpenAI from transitioning to a for-profit firm. In response to that, OpenAI CEO Sam Altman promptly posted on X saying, "No thank you, but we would buy Twitter for $9.74 billion if you want." Question over here, how realistic is it for Musk to buy over OpenAI, and what does it say about the firm's transition into a for-profit organization? And given how OpenAI is a private company, should a deal be completed hypothetically, what would this mean for investors of Tesla, which is by Elon Musk, and also of Microsoft, which is the backer of OpenAI?
Well, I think firstly, there's obviously a lot of tussle here. The bid of $97.4 billion for a non-profit organization, I think that will probably not go through. I think looking at that, the current OpenAI valuation right now on a pre-money basis stands at about $260 billion to $300 billion, especially with SoftBank closing in on the $40 billion investments. So there is still quite a big gap compared to the $97.4 billion bid by Elon Musk. There's actually a very, very strong gap. So what we think is that Elon Musk is probably a late mover in the AI race. Is trying to show it wants to be emerge actually victorious in this race. I think there's a lot to be seen with a lot of competing products, especially with DeepSeek, Alibaba, ByteDance, all coming into the field. We do think that there's going to be a lot of competition in this field. So I think a lot to be seen there.
I see. Lots to watch indeed. Thanks so much for the insights, Jeremy. That was Jeremy Tan, CEO at Tiger Fund Management. Thank you so much for joining us on Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance.